In this video, I'd like to consider the implications for investors of the Labour Party proposals as expressed in their manifesto on income tax and capital gains tax. Now, of course, any investor would probably, ideally, like to secure some income from their investment and some capital growth. And of course, the way in which the income and the gains are taxed are quite important because it's what you're left with that counts. So let's have a look at income tax first. You'll be well aware by this stage that whilst the Labour government proposed to retain the current basic and higher rates of tax at 20 and 40%, once you reach the level of £80,000 of taxable income, then the rate will jump from its current 40% to 45%. And when you get to 125,000, the so-called super rate of 50% will apply. So that's material increases. The other big change for investors is that the taxation of dividends will be radically changed. Now, we'll lose the £2,000 dividend allowance and it won't be replaced with anything. And dividends will, according to the manifesto, be taxed as income, which means ordinary income, which means that currently, for example, if you're a basic rate taxpayer, you'll pay 7.5% on your dividends, whereas under the new rules, it will be 20%. If you're a higher rate taxpayer, you'll pay 32.5% on your dividends. Under the new rules, it's going to be 40 or even 45%. And if you're an additional rate taxpayer, it will be 38.1% currently, and now we'll be looking at 50%. So quite material increases. Interestingly, the biggest jump is at the bottom end for basic rate taxpayers, jumping from 7.5 to 20. So all of that means dividend income is going to be taxed more harshly, whoever you are, pretty much, unless you're a complete non-taxpayer and you have your personal allowance available. So most people will be taxed more heavily on their dividends. Then you look at the capital gains, and it's fairly common for advised investors, at least, to look to use their annual CGT exemption every year to increase the base value of their investments, to minimise the eventual gain, taxable gain, that they make on their investments by using the annual exemption each year. Well, the annual exemption is going to go away and it will be replaced by a £1,000 de minimis exemption. And not only that, and perhaps even more important, is that capital gains tax will be effectively income tax, because capital gains will be taxed at the same rates as income. So we can be looking at the difference between 10% and 20% for basic and higher and additional rate taxpayers respectively, 28% for property gains. And just the gains being taxed as income, so up to 50%. So put that all together and the landscape looked a little harsher, a little more bleak for investors, particularly higher rate taxpaying investors, but also basic rate taxpaying investors in relation to their gains and income. So what does that do in terms of investment decisions? Well, it certainly makes tax efficient investments seem even more attractive, because when you have an even harsher tax regime, tax efficiency, both getting relief at the front end and having tax favoured funds that you invest in, look appealing. So obviously pensions and ISAs. It's reassuring that there was nothing in the Labour Party manifesto that says the reliefs available currently for pensions and ISAs would be in any way diminished. So that's a good thing. So yeah, look closely at tax advantaged investments. And then we could consider the fact of holding investments that generate income and capital gains will look slightly less attractive. So direct equities, unit trusts, DFM portfolios that produce real income and generate real capital gains, with those rates changing, makes them less tax attractive on the face of it, and without any other legislation being implied. The deferment qualities of investment bonds, UK and offshore, may look more attractive. Now, there'll be a lot more to come on this, a lot more detail, if we have a Labour government in their first budget. So these were just a few thoughts, early days as it were, on what those changes proposed could mean for investors if implemented. We will, as I've said in past videos, be keeping a very close eye on where we are in relation to tax proposals as we move towards the election, and then even more so beyond that towards the budget of whichever party comes out winning.